Our moderator this morning is none other than Drew Gilbertson, Director of Industrial at Oxford Properties. He leads the leasing, P&L and growth for Oxford's industrial platform in Greater Vancouver area. And in addition to this role, he was recently being tasked with the planning and execution of industrial developments in Western Canada. Drew will lead a highly qualified panel this morning, and I'm very interested, as I'm sure everybody in the room is, to hear what they have to say. So to introduce the panel, I invite up to the podium Mr. Drew Gilbertson. Good.
Check. Perfect. Thanks, Paul. Really appreciate being up here. Good to see a full room and get this discussion going. So today we've got an awesome group of guys, group of people to discuss the industrial market. And so first, just before I start introducing folks, I just want to take care of some minor housekeeping items. So we're getting everyone engaged here, and we're doing live polls as we work through some of the segments in our presentation. So just take a look there with the QR code. You'll be prompted on when that is, and then also questions to the very end. So without further ado, get going on the introduction of our panel here. Sorry. So first is Mr. Ben Taddei, the COO of Conwest. So come on up, Ben. Ben is a real estate professional with over 31 years of experience in the Lower Mainland. Currently is the COO of one of the leading privately held developers and site services companies in the Lower Mainland. Prior to Conwest, he led the operations of 2 prominent housing companies. Through his team-based approach to management, his guidance ensures mutual success for all his stakeholders. So big veteran presence on the board here, and has some interesting opinions that we'll get to. So glad to have you, Ben. Next up is our deal maker, Mr. Ryan Kerr, the optimist of the group. Ryan specializes in industrial leasing, sales, land, and investment sales throughout Metro Van. He's an integral part of the AY Industrial Services Group and has represented a variety of businesses involved in the development community, investors, manufacturing, and logistics users. During his tenure at AY, he has been a lead negotiator on more than 8.5 million square feet of transactions, and that valued at $2.5 billion. So some good insight, a lot of experience there as well. Last, but certainly not least, is Mr. Josh Gaglardi, the president at Orion Construction. So Josh has an intimate knowledge of many of the projects that walk through his door on a day-to-day basis. He understands the unique challenges of building light industrial projects throughout Western Canada. He's involved here in BC and Alberta as well, and has a unique insight to all the different municipalities that he works in. Josh is involved from start to finish and has completed over $1 billion worth of construction in Western Canada. So before we move on to kind of the discussion, I just want to take a moment and acknowledge a huge accomplishment that Josh and his team at Orion Construction. So they have recently been awarded the #1 fastest growing company in all of Canada. So a round of applause to Josh and his team at Orion.
Thank you.
Huge accomplishment. So congrats, John. Congrats to his team at Orion. Okay, so moving on, we've got a good discussion for you here today. We're going to walk through a few different topics. Kind of the first one here is slightly mundane, some statistics you guys are probably all aware of, but it sets the table for what we're working on here and what we're discussing. So the first one, consumer spending. The reason why this is up here is because it's tightly held to absorption for industrial real estate in any market that you're at. So it's been waffling. You're kind of seeing it up and down. Overall consumer sentiment is starting to wane right now, which could impact what's happening in the future in terms of demand. Next one would be inflation. We all know the story here. It is starting to curtail from that 8.1% that we saw 2 months ago, and still ticking at about 6.9, so a huge factor as you go looking to build new property in the future. A bright spot in Vancouver, it's always a great story. Lots of people moving into the region, 1.5% per annum, growing at about 98 people per day. So what that means is more wallets ready to spend money, kind of back to that consumer spending bit as well. Lastly, the announcement yesterday, another 50 bips on the overnight lending rate from the BOC. So it's impacting and a huge topic of conversation in the Oxford world for sure, and on many of the folks in here about what that means for values, what it means for development, and what we're looking at in terms of new product coming out of the ground. One thing that's not up here is an overlying topic that we talk about all the time is land. Lots of discussion around that, generally speaking, but last time I checked, I don't think they've made any more of it here in Vancouver. So that's another overlying fundamental that we're talking about. On to the leasing market. So just some quick stats here as we walk into this discussion. We've seen these charts before about the growth, absorption, et cetera, but some other ways to look at it here. We've got a market that's showing incredible resilience in the face of some of these more cautionary tales on the macro side. So 5 years under 2% vacancy, 12.5 to 13% CAGRs in terms of your 5-year growth. So big growth we've seen there. About 10 million square feet under construction. So 85% plus or minus that is under contract or spoken for. Shows you the demand side of the equation. And then depending on who you're talking to, over 5.5 million square feet of requirements in the market. So some great stats there. And another thing that I look at is you might need about 14 million square feet to magically appear either in development completely vacant or 14 million square feet of occupiers just vanish from the market to get to 7% or a balanced market. So that's setting the stage, and enough listening to me here. So we'll move on to the next bit here. And talk about how we stack up, I guess, against the Western Coast market. So another way that we look at things is there one way in Vancouver versus what you're seeing on the West Coast? And as you can see here, in some cases, you're close to $3 a square foot. So might be some differing opinions on that here, and we'll get into that right now. So that's the leasing market, and on to questions here. So even though scarcity is still a major theme, are we beginning to reach an inflection point in the face of a possible recession? You're hearing about that all over the news right now. Are there any canaries in the coal mine that you're seeing right now? So I'll go to Ben for this one first.
We're talking about big base stuff, right?
Yeah.
Well, I don't think we're seeing any canaries in the coal mine here. This is a very narrow segment of the market, as everybody knows, right? So this comes down to a couple things. This is how we look at it. I think a lot of people here look at it the same way. You need large sites to make this work. There aren't enough large sites out there. And if you have a large site, and we have quite a few of them, if you're patient and you're looking for a good covenant, you'll get it. And the next question becomes, what's that lease rate going to be? If you go back to that graph in 2014, everything prior to 2014, lease rates were pretty stable, right? You can see that? So, weird fact, I joined Conwest in 2014. Okay.
Coincidence?
Yeah, right. Okay, and we would debate this out. And lease rates, everybody knows what they've done. So, question is, are they going to keep doing that? And the way we look at that is, what percentage of rent does that tenant pay as a function of their income statement? And when I was looking at that, it was actually quite low. Now it's probably tripled, and you're probably getting into territory where national covenants and international covenants are starting to take a look at their operating margins, and they're starting to question whether or not that's the right number and what the alternatives are, right? And I have to preface my comments by saying I know nothing about Alberta. I've been there twice, and everything we do is in Metro Vancouver, right? And I know you were born there,
Yeah.
and there are people in this office that know a lot about Alberta. So I can't comment on where that tipping point is between being in Vancouver and being in Alberta, but I have to imagine it's getting close. And anecdotally, I'm hearing that there's a lot of those national and international covenants that are looking at that spread and justifying the rents they're paying here. So, so are we going to see those big bay rents top out? I don't know. My bet is in the short term, probably not.
So
I don't see any canaries in the coal mine here, but there are many dead birds everywhere on all the other segments.
yeah, I'll get to that. Okay. So yeah, that brings me, just want to bounce that off of Kerr. So, you're seeing all sides of it. So what do you think is?
You talk about 14 million square feet coming back to become healthy.
Yeah.
We got 5 million square feet completed in the next 24 months. 5.5 million square feet of active mandates, which I think is light. Of the product coming available in the next 24 months, I know about 60 to 70% of it's being pre-negotiated on right now at record-setting rates. I don't see a big comeback of space. I mean, I hear more from my clients about lack of labor. I'm like a therapist now, talking about warehouse workers not showing up and kids who don't. We can talk about kids later, but their staffing issues seem to be much more challenged, and I just don't think we have enough there to set everything straight.
So, kind of a tail to that. How are you strategizing and advising your clients in the face of maybe not the labor side and being a therapist, but just about their real estate? So, how are you going into those discussions?
Well, on the landlord side, we had a group in the other day. How do you deal with leasing space? And I think it's getting as many competitive bids to the table and getting the covenant you want. Maybe taking a bit of a hit on rate to get a group you're really happy with. But there's no shortage of groups out there looking for space over 50,000 feet.
Are you a bull?
I'm the bull. I'm the bull.
Okay.
Yeah.
So yeah,
Guess
we
what
were
he
talking
is.
about this before. We think Ben is the bear. So that brings me to the next question. Next 12 to maybe 24 months, what trends are you predicting in the leasing market, and how are you looking at that in your portfolio?
Okay, so the greatest team in the business is right there. And I forced them to come here because I thought if I was going to get in trouble, I'm going to start beating on them. Right? But, they warned me. They said, especially Alicia, she says, don't be too negative. Okay. So I'm trying not to be negative. I'm just going to tell you what how I look at the market, how we look at the market, and what we think is going to happen. Because at the end of the day, the market, like your outlook is just a bet, right? We're all just making bets on where we think this is going to go, and there are so many variables that you need to consider when you're. So, yeah, all I'm going to tell you is how kind of we're looking at the market. And there's a funny story. When we first got together, I think I sent you guys a slide of housing prices remember this?
Yep.
From 1977 to today, right? The average prices. And if you take a look at that curve, it's pretty flat from 1977 to 2002. It does this, okay? Joe Kerr is nodding because he's older than I am. Okay, so after 2002, it does this, right? And now it's starting to do this. Okay, so when you've been around a while and you know that real estate is a market cyclical business, and you've been through, if you've been into it for 32 years, and you've been to 5 different slow periods or recessions, it's in your brain, okay? And you get used to looking for the signals. So I live in paranoia, and I live in the future, right? Because when you're running an operating business, yes, you have to operate in the present day, but you really got to take a position based on what the future is going to tell you, and you're looking around corners for things that are going to come at you. So that's how we collectively look at the business. And I feel really sorry for the people that I work with, because every day I send them, 5 to 10 emails on... You can't hear in the back. You can't hear? Hello? Can you hear me now? Can you hear me? Hello? Just put your hand up if you can hear me in the back.
That's better, yeah.
Is that better? All right. So, yeah, what I was saying is I feel sorry for these guys because it's a constant barrage of emails, okay? And at the end of the day, we're in a cyclical business. And when you take a look at what's going on, revenues are coming off, hard costs are still increasing. The margin for a builder, depending on what sector you're in, has evaporated. This is a reality we face, right? But you have to remember, it is a cyclical business. So you're going from this regime to that regime. And that's where the pain comes in.
Okay.
So if you think of the world that way, and you take a look at what's happening in the world, there's a massive deleveraging going on, and there's a repricing of assets and risk, which means asset values are going to come down. That also means the economy is going to slow. That translates into vacancies in small bay, medium bay. This is how we look at the world. So I think it will get worse before it gets better. I think we're into a slow period. I don't think it's going to be as bad as the 80s. I think we just have to get from that regime to this regime. And I think that floor in that market is probably going to occur sometime Q2, Q3 next year. But I do believe that asset prices will be different than they were going into this. And that's what you need to build your business on, in our opinion.
So you think that lease rates are going to be flat this year?
It depends. I think that I'm talking to more guys in the past few days, and there are people here that know a lot more about this than I do, right? But what I'm being told is in the small bay market, it's starting to top out. I'm hearing that yes, there's been a flurry of lease deals done, but there's fatigue that's occurring in the business right now.
Yeah.
And I think you'll see more of that in the small bay.
Just to keep kind of the pace running, I know Ryan's got something to say here.
Now the bull comes.
We were going to go to the group here for a poll to find out what the room thinks on lease rates. So Ben thinks it's flat. I think Ryan is going to say next 12 to 24 months.
Let's give me this. Before the poll, I can't talk about the 90s. I was wearing Spider-Man underpants and watching the Blue Jays. Is my mic now? Okay. But I can tell you right now, and I know, do you know how many standing vacant buildings are over 50,000 feet in our market?
One.
I actually think it's 0.
Yeah.
So I don't think we have a return to healthy coming, and I think we're going to see continued growth at least into the mid-20s in rates.
It looks like Ryan is aligned with the room here at 5 to 15%. So maybe
a lot of brokers in the room.
Yeah.
Onto the sales and investment market, which would be the next slide, not the next poll. There we go. So we'll jump through this pretty quick here. I think we're all aware of where some of the stats are on the lending environment, et cetera. But one of the things to highlight here is the $680 asking prices on the sales side, a new record high. My personal view is that that's probably starting to tap out. And the story here is pretty simple. Purchasing power has been diminished substantially by the fact that there's a new lending environment right now. So you may start to see that tail off. We'll get into the strata-specific questions with Ben and Ryan, who are really well educated in that area. On the investment side, we've seen a 74% price increase in terms of asking rates there. Cap rates are falling or have been falling in the past, but it's now starting to look a little bit different against the actual 10-year GOC. So you're seeing 3.62 there. And wanted to highlight the average spread in the last 3 years, and that would be based on a lot of the tailwinds that we've seen in the industrial market around the pandemic and acceleration of e-commerce, et cetera. The skinniest that it did get was about 40 basis points in that time period. And now, depends on who you're talking to, I think there's a lot of different discussions, depending on who you talk to today. But we're seeing pricing kind of in the mid-4s, I would say, on existing products that's out there. But the real theme right now is that pricing discovery, a theme of pricing kind of discovery for buyers, et cetera. So that's really the table setting for the next bit here. So I thought I'd throw this quote in here. kind of as we look at strata versus lease, this was something from last year. I think the tables have turned a bit in terms of where the market is. So my question actually is going to go to Ben first, and a bit of a softball here, but has the strata market cooled in terms of prices that you guys are and other competitors are getting out there right now?
I need my mic back. Okay, I'll try not to talk. Hello? Okay, I'll try not to talk. Yes, the market's cooled.
No, market's on fire.
When I look at these graphs, I think of the Fed, right? It's so everything's backward looking, and like I said before, we look to the future and we look around corners. We have 24 projects. We have projects in almost every municipality in the Lower Mainland, and we have 4 lease projects and 4 sale projects. So we have a good view of the market, and we've seen strata sales decline incredibly, right? So Latitude is a good example, right? That's a medium bay product. We have one deal there. Everybody knows that. It's a standoff between us and the buyer. We'll see who blinks first. That's where we're at. And the more people I talk to, the more people confirm that, right? There's no bid, is my point. So when there's no bid, how do you value something? You can't value something. So then the question becomes, well, what do you do? So what we do is nothing, because we believe that this market is not going to last forever. There is no inventory. I totally agree. We will get our price. We're just going to have to wait for it. And why sell something below replacement cost just to do it all over again? It doesn't make any sense. So that's how we run our business.
I agree with you.
Yeah. Perfect. There's some agreement there. I'm actually going to throw this over to Josh, just because he's kind of on the front end of a lot of these, working pre-con, looking at strata stuff early in the, so what are you seeing in terms of activity leading up to maybe new projects? Are you seeing anything interesting there?
Yeah, the new project pipeline has been pretty slow the last few months. I think everyone's aware of that. A good barometer for us on the velocity of sales in strata is how many phone calls we get. So quite often we get phone calls from brokers, how much is an office TI? What can you do with the space? Got a purchaser, can you help them out with this? Or if we're working for the developer, can you help with some base building modifications? Maybe there's a cooler or a freezer, they require under slab insulation. We're not getting any of those calls. So either that market's dried up or people don't like us anymore. It's also an option, but one way or another, that is our barometer of what's going on right now in the market.
Yeah, so certainly kind of a good anecdotal barometer for sure, which I thought is very interesting. And now we'll go over to Ryan, just around actual expectations on strata sales prices at the end of kind of this year. Where do you see those going?
I'm with Ben on do nothing, and there are some very well-capitalized private developers, Conwest, BD, PC Urban with partnered equity. These groups can be patient and won't chase the falling knife. Where people are going to get caught or where pricing is going to get chased down is by small, private, speculative, flipping-oriented investors who, a lot of them tried to use very little capital to build a nest egg for themselves, and they're getting capital calls and can't get financing that they want, and they're going to go hit the bid and they're going to chase it down for the next year. But the users are there, and maybe not calling Josh, maybe they're calling somebody better. but we're working on a resale of 2 interurban gateway units down in South Van, $750 a foot. Waiver this week. User fully plans on moving in. We also have a project with PC Urban out in Barnett Highway in Coquitlam, in a place that's very underserviced for strata. And we've got groups who are chasing us with LOIs already, which is like that's a good news story. But speculative investors are going to drive pricing down, and that's the problem.
So a bit of a different story in some of the sub-markets.
It depends on how much standing inventory and where you're at in your construction cycle.
Great plugs, by the way.
Yeah.
I practiced that in the mirror this morning.
Okay, so just moving on, maybe switch gears from strata to the investment market. So before we get to kind of the poll, which looks like a lot of folks have already answered here, I do want to kind of ask Ryan if he was to bring a fully let Class A industrial building to the market right now, where do you think that would trade and why?
Big question. I think you have to look at when the lease was negotiated. So if you're fully stable, we have a little sale leaseback deal we're doing at the moment. Fully stabilized, nobody's going to argue up or down that rent isn't market, and modeled with today's debt conservatively, and we're in the mid to high fours. However, if we're also working on something kind of what you're talking about, but a bit more historical lease in place, because lease rates have continued to go up, and we're going to be into the high threes. So it really depends on lease rate growth built into your lease rate, when the deal was negotiated, how much has the market continued to go up. I don't think you can just throw a dart at the board and pick a cap rate these days.
Yeah, similar story to years past. I think there's probably a bit more upward pressure in terms of negative leverage. Depends on how the deal is structured, right? If it's cash buyer, etc. Maybe on to Ben, who would be putting money out there. I know it's not necessarily your play to be buying IPP, but if you were maybe on the disposition side, perhaps where do you think you'd be targeting?
Are we going to sell anything? Marinelli says no. Yeah, so yeah, we're not going to sell anything. I don't know how to answer this question.
Okay.
I think if you're a developer looking for land and you want to build, you want to add to your IPP portfolio, that's a better way to look at it from our perspective, because that's what we're doing. What's that cap going to do? And what are you buying in at? I think that that cap has to go up. And why does it have to go up? I think it has to go up because a lot of the guys that are buying existing IPP are very different than us, right? They're guys like you, right? And when you take a look at how you guys make decisions, you have a lot of opportunities to deploy capital, and those returns have to be commensurate with the risk and the time and all that stuff. And you're getting more and more options. I'm hearing from a lot of guys that I talk to that are in the institutional world that they're reallocating portfolios. They're starting to sell income assets to rebalance things. They're moving money out of Canada. These are the things I hear, right? And all that adds up to cap rates have to go up. But what do I know? I mean, half this room knows more about that than I do. So
Yeah, it's generally our house view, but that's just one person in the room. So
we were out in Toronto. We asked Oxford if they wanted to meet up to look at a deal, and they said no. So I know where your head's at. But we've met with 20 or so groups out in Ontario in the last month. Got back last night. Many of these groups have raised funds. One, industrial and multifamily in Vancouver are still the green checkbox in the institutional world. And I mean, you can see why. The market is a very comfortable place that you're not going to lose money from an IPP perspective, and that you can still forecast growth in. So I think there's tons of institutional capital that will bail out and kind of backfill the demand from some of the traditional private local groups. But yeah, I mean, I agree with you, cap rates are going up because cost of debt's going up, but I think demand for industrial IPP in Vancouver is strong as ever.
So that kind of brings me to the next question. You answered a little bit, but in the next 1 to 2 years, who do you think the most active buyers are going to be?
I answered my question.
Yeah. So yeah, you're talking institutional groups, and that's the feedback you've had when you've done your road shows in Toronto.
Or those, and we have some very wealthy private high net worth families in Vancouver. Many of them are in the room. These groups have not too much leverage on their portfolio. I think Taddei, I was talking to Paul earlier this morning, have very little debt on their books. They're going to be very well capitalized, They're going to be looked at as a very strong group to lend to, and I think they're going to see great deals. And the Dayhues, the Beatties, these group they're still going to be buying in this environment.
Can I ask a question?
Sure.
Why is nobody doing anything now? And the second question is, what has to happen for them to start doing this?
Hear me out.
Bingo.
Anybody who's taking asset to market right now, and we talked about the Mexican standoff and where's pricing? I want yesterday's pricing. It's not there, kind of thing. Anybody who's actually a real seller in this market understands that things are changing. Like, they see the debt. Like, we don't have to go tell somebody that Bank of Canada raised rates. So it's nice. You don't have to beat up your own client. But I think the deals are already in play. I mean, Darren's got the old Eddie's building out for sale at the moment. I think there's a lot of stuff that we don't know about that's all going to hit in the next 6 months. I think it's all happening, and anybody who's really a vendor is a vendor at today's price.
I guess time will tell. So varying opinions kind of on where the room stands on cap rates and where they land at the end of the year. Lots of upward pressure in my view, but that's, again, just one person and one company. So carrying on to another important component as we discuss the market here is construction pricing and what's happening in the construction market. So we have our expert here with Josh, and want to get through a few things here which are definitely important. So this is a chart that Josh sent over my way, and kind of interesting. You can see on the left there, you can see we've got numbers all the way up to close to 300%. Lumber is the biggest hump there over the pandemic as people are fixing up their homes, etc. But what I've highlighted here is at the end where you've got some input costs raising by 2x in some cases. So steel is one of those, and we'll get to that in the next question here. But construction costs generally have risen substantially over the past year, and anecdotally, we've run some pricing exercises on some of our developments across the country, and they've flexed by 25 to 30% over last year, which kind of is tough to underwrite when you're looking in the future. So moving on to the next bit of questions. So as you have materials level out, you also have other ones that come up, so it's a bit of whack-a-mole, or one fire goes out and then the next one starts to burn a little bit brighter. So a perfect quote from Josh here in terms of the construction aspect, and what I want to talk to him about is, what do you see material prices doing in the next year, and is there any factors that may impact that or kind of start them to curtail?
Yeah, I mean, that graph shows a pretty good representation of the last 2 or 3 years. So the cumulative effect of all those additional costs is about 35% since 2018. We're starting to see a very, very slow sort of settling of construction costs, and every time I try and predict construction costs, I'm always so far off, so don't write any of this down. But right now, we're getting trades calling us more often, asking, what projects do we have going on? Do you have work coming up? Whereas 2 years ago, you had to call those trades and say, hey, do you want to work for me? Can you work for me? So that dichotomy is changing a little bit, which is really great. It shows that maybe the market is slowing down a little bit. In the next 12 months, we're hoping that costs are going to come down, 10, 12%. I think most of that is from materials. I don't think that labor is going to come down very much at all. Over the last 5 years, we've seen labor go up 26% on construction. There's an acute labor shortage of skilled construction workers in BC, and so I don't think we're going to see any decrease in pricing from labor. I think it's all going to come from materials. And Daily Hive posted an article yesterday I thought was quite interesting. Right now, the BC capital projects are up to $135 billion, which is 80% higher than it was 5 years ago. So whether or not a handful of private projects slow down really isn't going to affect the overall labor equation in this province. Without some sort of innovative breakthrough that replaces labor, I think we're going to continue to see a very slight decrease on materials, and then sort of consistent strength on demand from there on out.
Yeah, so as materials come down, labor just basically keeps it constant.
Yeah.
And in Alberta, same effect, where you've got the oil patch firing up again. A lot of folks out there are scared that they're going to draw out all the labor again, and just keeps consistent. So some good insights there. You kind of beat me to my next question around kind of labor costs. Are there any other variable costs that folks in the room here should be watching out for moving forward?
Yeah, I mean, you never really know as much about your supply chain as you think you do. We saw significant increases on our costs when gasoline went up quite quickly there because of the war in Ukraine and Russia. So, it's really hard to predict what's going to be next. I never would have predicted coming out of the pandemic the supply chain shortage and that effect on our pricing, and then, the war and that effect on our pricing. So, it's really hard to say what's next, but I'm sure there'll be something.
Okay, so last question for you. How are developers dealing with some of the uncertainty and the long time frames here? I mean, you've got projects that do take a long time to go vertical, whether it's through permitting, earthworks, site prep, et cetera. And what strategies are you adapting to help kind of calm those developers down or serve your customers?
Yeah, we've moved procurement further along in the project lifestyle. So we're asking our clients to procure their materials earlier, and work with them on pre-purchasing materials and storing those materials on site or in warehouses nearby. So we've been able to hedge costing quite a bit with that strategy, but there's only so much you can do in terms of buying fully engineered, fully designed materials for your project. So it's only a small piece of the pie, but we've been successful with that strategy to date.
Interesting. Again, some good insight, and it's nice to have a construction person up here talking about some of the other costs going into everything we're doing. So we did have a poll question here on where folks see overall construction costs moving by next year. So it looks like kind of similar to Josh's sentiment, you're somewhat close to your rate of inflation almost, or 0 to 5%, so pretty not as aggressive as you may think,
yeah,
which is promising. So that kind of brings us to the next, or the last section, which would be land and development. So you've got a situation here where, depending on who you're talking to, you've got a stable leasing market, strata prices are off, debt pricing is very, very volatile right now, causing negative leverage. Construction costs are, call it, unpredictable. And uncertainty seems to exist in terms of pricing and when you're talking about the market. So it sounds like a perfect environment for new development, or also chasing land positions. So I would say it's an interesting time in the market right now. You do hear a lot of different opinions when you talk to brokers out there, but wanted to get to a question that's kind of burning probably a lot of people in this room here is, land pricing. So land pricing, kind of anecdotally, we've seen come off 25-30% in some of the other markets on the West Coast that have similar constraints. I know it's not a perfect apples-to-apples comparison, but a bit of a yardstick. Are we seeing something similar here locally, and who might be those buyers, or are pricing changes still working their way through the market? So I'll shoot that off to Ryan, and then probably get Ben's opinion.
Thanks. Land is off for sure, and I think I'd be very curious to see who actually goes firm and closes on land with expensive land financing in this environment. I'd say the good news is that peak land pricing is probably coming down, so when the groups are ready to jump back in, they're going to probably feel a lot more comfortable about getting into the land pricing of, spring of next year. The only thing I'd say on the converse side of that is that IPP land is going up with lease rate growth. So ideally, we get to a point where land gets to a place where IPP can be built and lease projects can fulfill the need for lease space in our market.
Okay, Ben, what's your take on the land market right now?
Yeah, I agree. I agree with half of what Ryan's saying. Land is worth less today than it was 12 months ago. It's probably worth, in my mind, 20% less. But once again, how do you land on that number if there's no bid on a strata? Because the land value for strata is likely going to be higher than what it's going to be under a lease scenario, in my mind, in the medium term. So, so land is worth less. I do think, though, that who are the buyers? we are always buying. We're always in the market. What we pay is a function of the deal. What we pay is a function of what we can do with it. And you know, we have and will be closing on a lot of land this year, and those are still good buys. So, you know, looking at, and we've seen more land in the past 45 days than we've probably seen in the past 18 months. You know, but a lot of it's still, you know, way overpriced. So, you know, we look at it all, we understand it all. When you underwrite it, you realize it's not worth what people are asking. But the other major point is back to the market cycle, guys, right? This is all very predictable. So what's going to happen here is, and I want to just counter one thing Josh is saying, because we also have a civil company that we run. And, you know, what we're seeing in the civil world is a lot of local developers, residential or commercial, have paused projects. And starts, like housing starts this year in Metro, I think are going to be sub 20,000. They were 30,000 before, right? So you're knocking a third of the demand for our services off the table. Okay, so what does that mean? I think if you're a labor or a service provider in a market where 30% of your market is evaporated, which is very typical for this part of the cycle, some prices have to come down. Mm-hmm. Right? It's not going to save your project. It's not going to make a difference on what you can pay for land. But, you know, to Josh's point, you know, at least people are phoning it back, right? So this is what we're seeing. The friends that I have that are running, you know, development companies in town, housing companies, commercial, whatever, you know, we share the same view because we're operators, and we need to make money in the short term, right? Like we have units to sell, right? So this is how we look at the market. So I think those guys are probably still kicking tires, but they're not buying, and there will come a time when those guys and we think that market is going to flatten. Mm-hmm. Okay, and I like to buy land in here in the market cycle, right? I don't have to buy it at the bottom. I like to buy it in here, and I don't mind buying on the up, because as long as you've got inflation and that market is moving, you can still make a margin, and it's the margin that saves your business at the end of the day. So. Those are my thoughts on the land market.
I didn't disagree with that, just to be clear. I don't know.
You confuse me when you talk, I don't know.
I confuse myself.
Yeah. So,
broker speak.
Yeah. Kind of on to the last little bit here as we kind of close things out. If you, onto your thought there, so if you'd purchased something about a year ago, you may have answered this earlier. Is it more conducive to build to lease or build to strata? And would you actually go on the project, or are you just going to be waiting it out based on kind of what's happening right now?
Okay, so I know I sound pessimistic, but I'm actually a very optimistic guy, because I think you have to be optimistic to be in this business. So we started Grace, which is 44-unit townhouse project on 30th and Ash in July, when the world was, you know, falling apart. And with no pre-sales, we just started it. And we're sitting, we hit our pre-sales target, we've sold 16, they're all firm. It's a great project, it doesn't finish for 2 years. We're moving forward. We started Riverworks, same thing. Started the building, no pre-sales. That thing is doing really well, right, Sean? Right, okay. It'll take us another year and a half to finish it. Pivotal is going to finish in March. We've only got, 9 left there. You know, and Latitude, you know, these guys are doing a great job. The market is the market. We're pushing forward.
Sticking to the program.
Right, sticking to the program, right? Because at the end of the day, you know, back to the cycle, back to, you know, the chasm, you look through it. You look through it and you look at the landing spot and you say, am I going to get there? What's the probability? What's it going to look like? So we're bullish. But you got to remember, we have margin because we bought that land at historical numbers. So we can do that, and I think that's what's going to happen. Right?
So
and
on new land pursuits, it's a wait and see attitude, basically, on that price discovery theme.
yeah, it's a wait and see, but it'll happen. Guaranteed. And this quote is very apropos, right? I think if like change brings opportunity, guys. When the market is constant, there's no opportunity. So whether the market's moving up or whether the market's moving down, it's that change function that causes uncertainty, that causes opportunity. And if you're in the game and you know what you're doing and you have good relationships and you're well capitalized and all those good things, you can do well in those markets. So the worse the market gets, the happier I get, quite frankly.
There you go. So I did want to kind of ask Kerr and Josh as well, just to close out the last question here, is what are the new or potential opportunities on that theme that you see kind of coming out of this, let's call it turbulent market or uncertain market?
You want to go first?
We're still happy to build for anybody.
Yeah.
I think there's some, you have to be cautious out there right now. The nature of our business is, primarily fixed price contracts. And, we're seeing anecdotally some small or medium businesses facing some really challenging times. And that's going to continue on for the next little while. And, there's going to be some people that don't come out of it. But I think there's a lot of people that will come out of it, quite strongly. And I do think there's going to be a lot of opportunity on the backside of this, for sure.
I think the land pricing adjustment is a good thing. It was getting a bit, drunken college party excitement level. So seeing that calm down and normalize a bit, so it's not so scary, I think that's a great thing. But I think just over the last few days, you can still see a ton of liquidity out there. And I think, although somebody wanted, there's so many of these vendors are old privates who own their assets, and they said, I don't want to miss the top of the market. And they got to the top of the escalator and they started coming back down. I think a lot of them are going to now look at disposing of those assets, and there's still a ton of liquidity. More likely it's going to be institutional in nature, and I think there's going to be a lot of deals, and it's great for all the brokers in the room. Broker pump up.
Okay, there you go. Yeah, you can make money in a market going up or down, just not when people aren't making any decisions. Interesting outlook there. And certainly a lot happening in the market. I think it's still optimistic, but it's just being a little more careful. A lot of those kind of, keeping your powder dry is a buzzword that a lot of groups would use. That would be a sentiment for what's happening out there.
Don't call Drew with an opportunity.
Oh, yeah. Shots fired. Okay. Okay, so that really closes out a lot of the program that we have here, and I know we've got a few minutes left. We get a little tight here on time, so maybe one question came in the door here, and I'll get that going here. Anyways, it was basically about so we were talking about land prices and where things are swinging to, and this does come up. You are seeing a lot right now is just alternatives in design to kind of overcome some of the issues that developers are facing right now. So would that be stacking it even higher? We're seeing a lot of those projects and looking at it. So this question is probably best for Ben. So curious if that is something you want to answer. What's the question? Yeah, it's supposed to show up on the screen here. Okay, so yeah, it was basically looking at alternatives to design and what do you look at to overcome some of these issues that we're facing right now. Would you stack higher, or would you look at more density kind of in this current climate?
Bigger mezzanines.
Yeah.
100% mezz.
So the answer is always it depends. There's a lot of variables to think through there. And I'll just tell you how we look at it. So yes, in the long term, intensified industrial is a thing. Yes, it's going to be a bigger thing. you will see bigger plates. You will see taller buildings. You will see multi-level. I'm not talking 2 levels. I'm talking 8 or 10. But what is the timeline? That's the question. And what's it going to take to get there is another question. Because at the end of the day, it's not a preferred product type. The preferred product type is what we build, which is what most people here build, which is single-level industrial at grade. And you're forcing people into a product that they really don't want, and the only reason they do that is because they have to do it. And the analogy I keep using is, I'm old enough to remember when a food store in this business was only leasable if it had an anchor, like Safeway or Save On, and a bunch of little CRUs, and a massive parking lot in front of it. And when the urban model started to come into effect, and you're pushing people up the second floor with movators, it was really hard sell. It was really, really hard sell. Now you don't even see a food store that isn't in that format. So that's where we're going. But the question is how long and what's it going to take, and how expensive really does that typical preferred model need to be to push people into substitutes? I think it's got to be a lot more expensive for 2 reasons. Primarily, like you look at the construction cost. Like if I asked you to put together a budget for a 4-story, multi-level concrete industrial building.
I would love for you to ask me to give you a budget.
Right? Like,
but you're
now? You
four.
want it now?
There's a
500 a foot,
Yeah.
right? 600 a foot,
Yeah.
like you name it, right? Plus
not
soft costs. Okay, well then what's the rent got to be on that thing, right? And it's double what. So, we're still a long way away from there. Just to be transparent, we're not really looking at those models anymore. Yeah, there will come a time when we'll do that again, but not for a while.
Yeah, there's a lot of things that need to add up kind of before you pull the trigger on it. So that was the question from the audience. I think that wraps things up for today. And just going to pass it off to the folks at NAIOP to finish off and get you folks on your way.
Thank you very much, Drew. Let's round of applause. I think I would categorize that as bull, matador. So thank you all for attending today and for being on the panel. Before we wrap up, we'd just like to thank our platinum sponsors for the event, Avison Young, CBRE, Conwest, Ani Group, Oxford Properties, and Strand Project Advisors. At the gold level, CoStar Group, Farrell Estates, JLL, and Omicron. And at the patron level, CDC Construction, Lee & Associates, Morgard, and Rain City Industrial. I hope you all enjoyed today, and we look forward to hosting everyone in November for our office market outlook. I'm Ted Milden from Oxford. Thank you.